I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. This video will explain everything you need to know about indexed annuities, which are really interesting but often complicated and confusing. And be sure to watch to the end, where I discuss when an indexed annuity may be worth considering. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. While an indexed annuity obviously has the word annuity in it, it's actually very far removed from a traditional plain vanilla annuity you may be thinking of. In its purest form, a basic annuity, otherwise known as an income annuity, is where you hand over a lump sum of money to an insurance company, and in return they guarantee to give you a fixed monthly payment for the rest of your life. For more information on income annuities, check out my other video, What is an Income Annuity? While an indexed annuity may offer the ability to be converted into an income annuity, there really aren't many other similarities. So why is it so called an annuity? Even though different types of annuities look and act very different from one another, they all share two common denominators. One, they are products created, sold, and managed by insurance companies. And two, all monies in them grow tax deferred, where you don't have to pay any income tax until you eventually take money out. There are three general types of annuities: income, variable, and indexed. There's actually sort of a third and a half type of annuity called a buffer annuity that sits halfway between a variable and an indexed annuity. But for all intents and purposes, you can consider buffer annuities the same as indexed annuities. And for each of these three main types, there are subtypes of immediate or deferred. This video will discuss indexed annuities, specifically deferred indexed annuities. While I think there may possibly be immediate versions of indexed annuities, most if not all of them are deferred, so I'm just going to focus on that. The term deferred refers to when you start receiving income payments, if you choose to receive income payments. When they are deferred, they start at some point after 1 year, whereas with any form of immediate annuity, payments would start within the first year. Again though, as you'll see, indexed annuities usually fall into the deferred classification, not immediate. In a nutshell, an indexed annuity is an insurance product where the interest you earn is referenced off the return of a major financial market index. Most commonly, the index referenced is the S&P 500, which tracks the prices of the 500 largest companies whose shares are publicly traded on stock exchanges in the United States. Indexed annuities are also known as equity indexed annuities or fixed indexed annuities. The names are real confusing, I know, and you can thank insurance companies' slick marketing departments for that. But don't get too hung up on the names, they're all functionally the same. Before we really get into it, one of the most important things to understand about indexed annuities is that they are not investments in the stock market, even though they reference the stock market. Because of the way they're structured, which I'll discuss in a bit, it's almost certain they will never return as much as the stock market. But they offer downside protection, often guaranteeing your money won't decrease in value. That's a feature the stock market will never be able to provide. When you buy an indexed annuity, you're essentially just buying an IOU from an insurance company where they agree to give you a certain percentage of interest if the reference stock market increases in value. Like, for example, assume you give me $100 and we sign a contract that says if the S&P 500 increases by at least 5% this year, I'll give you $5 of interest. And if the S&P 500 instead decreases this year, I won't pay you anything. But you also won't lose any money either. You will still have $100. This, in essence, is an indexed annuity. Notice how you don't actually own any stocks. You simply have a written guarantee from me that I'm going to pay you something if the S&P 500 increases by a certain amount. Indexed annuities are contracts that last for multiple years. The most common lengths are 5, 7, and 10 years. When you buy an indexed annuity, you're usually locked into the contract for its whole length and can't take out much of your money during the contract term, at least not without following strict limitations or paying steep penalties. I'll touch more on this later in the video. Indexed annuities will typically give or credit you interest once per year, but it's important to keep in mind that the interest they credit you isn't like interest in a savings account where you can freely take it out. The expectation is the interest stays inside the annuity and adds to what's called your contract value. Assume you buy an indexed annuity with $100,000. your initial contract value will be just that, $100,000. If, after the first year, you are credited with $3,000 of interest, you then have a contract value of $103,000. Let's now discuss how interest is actually credited in indexed annuities. As I mentioned before, the interest you earn each year is not the same as the return of the reference stock market index. You normally only get some portion of that. After going through each of these crediting terms, I'll show some examples that will make this all come to life. Indexed annuities usually have a cap rate, which is the maximum amount of interest you will be credited each period. For example, maybe your cap rate is 5%. If the reference stock market index increases by anything over 5%, you'll get credited 5% interest for the year. It doesn't matter if the stock market goes up 5% or 20%, you'll only get 5%. But in most indexed annuities, you won't lose any money if the stock market decreases. As an example, if the index decreases 8% in a year, you will simply get zero interest credited to you. Your contract value will not decrease that year. Some indexed annuities have a participation rate, which is a percentage of the index's return you will be credited each period. Let's assume you have an 80% participation rate. That means your contract value will be credited 80% of whatever the return of the index is. So if the stock market goes up 10%, you'll only be credited 8% interest. And again, you typically won't have to share in any losses even if the stock market has a down year. Some indexed annuities use a participation rate in place of a cap rate. Others use a combination of both. Next, some indexed annuities have what's called a spread, which is a percentage deducted from the interest you'd otherwise be credited each period. Spreads can be used in combination with cap rates and/or participation rates. Let's go back to our participation rate example from before. The stock market increases 10% for the year, and your participation rate is 80%, which means you'll be credited 8% interest. But assume you have a 2% spread. That 2% would get deducted from the 8% so that you only end up getting credited 6% interest for the year. Clear as mud, right? Well, don't worry, this will all make sense in a minute. Also, some indexed annuities offer something called the bonus, which is an initial incentive of additional interest credited to your account. For example, the insurance company may give you an extra few percent of interest after maintaining your contract for at least a year. Now keep in mind, insurance companies are incredibly creative at coming up with new features, bells and whistles, and tweaks to terms and provisions of their annuities. There are infinite possible combinations of cap rates, participation rates, spreads, bonuses, and so forth. And for every feature or term that's to your benefit, there will be another that's to the benefit of the insurance company. There's no free lunch with annuities. As an example, if an insurance company offers a bonus in one of its indexed annuities, that bonus isn't going to be free. It's going to come at the expense of something else, like maybe you'll have to have a lower cap rate or a higher spread. Now let's walk through a couple examples to make some sense of all this. These features and figures I'm about to show are taken from real indexed annuities currently available on the market from a major insurance company. First is indexed annuity option A. Assume you make a $100,000 purchase and you select a 10-year contract term. This particular annuity will reference the S&P 500 index. Specifically, it will look at the S&P's percentage price changes each calendar year. It will give you 100% participation rate up to a 4.5% cap rate, and there is no spread. Interest will be credited to your contract annually. This graph shows how the product would have performed over the last 10 years. The blue bars show the S&P's percentage price change each calendar year, and the orange bars show the amount of interest that would have been credited to your contract value each year. You can see the maximum amount of interest you would have received each year was limited to 4.5%, which is the cap rate. And notice you never would have lost money even when the S&P went down in price. In those years, you would have simply been credited with zero interest. Now let's look at how your money or contract value would have grown over the 10 years. Recall you put $100,000 into it. In the first year, 2010, your account would have grown by $4,500, which was the 4.5% cap rate. Then in 2011, the S&P 500 was flat for the year. Its change in price literally rounded to 0%, so your contract wouldn't have gained or lost anything that year. And then you can see each of the remaining 8 years. All said and done, your contract value would have grown to a little over $136,000 by the end of the 10th year. That's a cumulative gain of about 36%, which equates to an average annual gain of 3.13%. Let's compare that to what would have happened had you instead hypothetically invested in the S&P 500. Assume you started with the same $100,000 of initial purchase. Over the course of 10 years, there would have been some up years and some down years, but overall, your $100,000 would have grown to over $289,000, which would have been a cumulative return of more than 189% for the 10 years. On an annualized basis, that would have been an average return of 8.15% per year. Obviously, the 189% you could have gotten by investing directly in the S&P 500 is significantly higher than the 36% you would have earned in the indexed annuity. Does that mean the annuity was a bad choice? Not necessarily. Remember, you can't think of it as an investment in the stock market because it's not. Our example clearly proves that. If you simply try to compare the total returns of an indexed annuity to those of the stock market, the indexed annuity is going to be the loser virtually every time. But it's completely unfair to view or consider an indexed annuity anything like an investment in the stock market. They're very different things. It's admittedly confusing on the surface because indexed annuity returns are keyed off the returns of the stock market, but that's where the similarities end. An indexed annuity is much more of a stable value, a conservative product like a bond. And that's how it should be viewed and used, not as any sort of alternative to investing in stocks. Indexed annuities like the ones shown here will generally end up returning a few percent per year. So from the perspective of expected returns, they're more like intermediate term bonds, but with the opportunity to earn slightly higher interest if the stock market does well. Granted, it's also not fair to compare indexed annuities to bonds because indexed annuities have steep withdrawal restrictions, whereas bonds don't. Also, many indexed annuities will guarantee some minimum level of return over the life of the contract. So even if the stock market has a horrendously bad run of years, your annuity will still produce some non-zero return over its life. Unfortunately, because of how unique they are, there are no other products out there that are apples to apples comparison to indexed annuities. So it's real hard to unequivocally say indexed annuities are inherently better or worse than anything else. Let's take a look at another example, option B. Assume again you put in $100,000 and you select a 10-year contract. Just like option A, this one also references the annual price change of the S&P 500. But here's where option B is different. In this case, interest will be credited based on a 60% participation rate and a 2% spread. Unlike option A, there is no cap rate. And similar to option A, interest is credited annually. Here is a graph of the returns. The blue bars again show the annual price changes of the S&P 500 over the last 10 years. The orange bars show the annual interest which would have been credited to the annuity's contract value. Unlike the flat 4.5% cap rate in option A, this one instead has a 60% participation rate. Looking at 2010, for example, the S&P 500 increased nearly 13%. 60% of that would have been about 7.7%. In other words, the annuity would have allowed you to participate in 7.7% of the S&P's price increase. However, keep in mind this annuity also has a 2% spread. That spread gets reduced from your 60% participation. So all said and done, in 2010, you would have been credited with about 5.7% interest. And you can see the same calculation was applied to the rest of the 10 years. Also, just like with option A, this annuity guarantees no losses. Your credited interest can't go below zero. So even in the years where the S&P went down in price, your annuity contract value would not have decreased. Now let's see how this would have ultimately turned out. Just like before, you initially put in $100,000. Over the 10 years, you would have ended up with more than $178,000. That's a cumulative gain of about 78% or 5.96% per year on average. If you had instead hypothetically invested $100,000 in the S&P over 10 years, you would have a gain ended up of over $289,000, which would have been a cumulative gain of more than 189% or 8.15% per year. No surprise, the S&P 500 again would have been a much better investment in absolute terms. But keep in mind, like I said, the annuity was never intended to do as well as the S&P. It was always intended to be a much more conservative and stable value product. The annuity's guarantee value will never go down. The insurance company takes on a lot of risk in making good on that guarantee. So to compensate them for that risk, they significantly restrict how much of the stock market upside gets shared with you. Let's quickly compare the returns of the two annuities, options A and B. Recall that option A would have returned about 36% over the 10 years, or 3.13% per year, and option B would have returned about 78% or 5.96% per year. Does that mean option B is a better annuity than option A? In this particular case, yes, option B would have ended up providing a much better return, but hindsight's always 20/20. If the S&P didn't have such a tremendously strong 10 years and only averaged single-digit returns each year, option A would have ended up providing a larger return than option B. I now want to discuss indexed annuity withdrawal abilities, or lack thereof. In the two examples I just showed, I assumed you never touch the initial $100,000 you put in. In each case, you let the money sit there until the end of the 10-year contracts. Maybe that was your goal, to invest money and never touch it for 10 years. But what if you wanted or needed to take some or all the money out during that time? Indexed annuities are meant to be long-term products. Unlike traditional investments, you can't just simply sell them whenever you want and get your money back. There are strict rules, limits, and fees around making withdrawals. Let's walk through some of the more common withdrawal features of indexed annuities. In most cases, you're allowed to withdraw up to 10% of your contract value each year without any penalties or fees. In our example, you'd be able to withdraw up to $10,000, which is 10% of the original $100,000 purchase, in the first year. And then each year thereafter, you'd be able to take out up to 10% of the then current contract value, which would have been adjusted for the cumulative interest credited you received along the way. If you have to make an excess withdrawal of more than 10% in a given year, you'll have to pay what's called a surrender charge, which is a percentage fee applied toward excess withdrawals in a contract year. Here's the actual schedule of surrender charges for the two annuities in our example. As you can see, surrender charges are quite steep in the early years and tail off over the life of the contract. In this case, if you withdraw more than 10% of your initial purchase in the first year, you'll have to pay a 9% surrender charge on the amount of the excess withdrawal. In year 6, for example, the surrender charge decreases to 5%. And then after 10 years, there is no surrender charge. So yes, that means after 10 years, you can simply take out the entirety of your contract value and walk away. You'll owe some taxes, which I'll touch on in a bit, but there won't be any fees or penalties. If you do take out an excess withdrawal along the way, in addition to paying the surrender charge, you may also have a market value adjustment. Depending how interest rates have changed since the beginning of your contract, excess withdrawals may be charged or credited an additional adjustment. That's right, depending how interest rates have moved, the market value adjustment may actually add money to your contract if you make an early withdrawal, but it could instead reduce your remaining contract value. You may also be able to purchase what's called an income rider as part of your annuity. The word rider is just insurance speak for extra option or feature, and all riders come at an additional cost. An income rider is an option that allows you to withdraw certain amounts of income each year for the rest of the contract's life and or the rest of your life, assuming you continue to keep the contract in force. This type of extra feature is most commonly called the Guaranteed Lifetime Withdrawal Benefit, or GLWB rider. Keep in mind, you normally have to purchase riders when you first enter your contract. You typically can't add them 1 or 2 years down the road. Another option to get money out of your indexed annuity is to annuitize it. Annuitization is the process of converting your contract value to a guaranteed stream of lifetime income payments. In other words, it's the act of turning your indexed annuity into a plain vanilla income annuity. And like almost all income annuities, once you decide to annuitize, the decision is usually irrevocable. You hand over your contract value in a lump sum and give up ownership or use of it. But in return, you'll get payments from the insurance company for the rest of your life. Now, even though income riders and annuitization may look similar on the surface, they are actually quite different. The main difference is that income riders still allow you to maintain ownership of the contract value. In other words, you can eventually take all your money out of the annuity and walk away. On the other hand, once you annuitize it, you lose that ability. You can't take out the contract value anymore because it's no longer yours. You irrevocably give it up in return for getting your lifetime payments. I'd like to mention a few other things to keep in mind with indexed annuities. First, there is no standard set of features per se. Insurance companies are really good at constantly coming up with new products and tweaks to existing products. If you go shopping for an indexed annuity, you'll quickly notice how mind-boggling it is to make sense of all their different names, features, and riders. In addition to the common features discussed so far, some may also offer the option to build in a life insurance component. And some will reference just the changes in price of the S&P 500, where others will reference what's called the total return of the S&P 500. Total return captures not only the change in price, but also the additional return from dividends that are paid. All else equal, it's better to have an indexed annuity that references a total return instead of just a price return. Others may actually make you participate in some of the stock market downside, but in return will give you more of the upside. Those that have you take on some of the downside are called buffer annuities instead of indexed annuities. And that takes me to my second point. Pay real close attention to your annuity contract before you commit to it. The contract will spell out all the details and mechanics of how the annuity works, and it will also explain how and when the insurance company is able to change terms, which is important, because some indexed annuities allow things like the cap rate or participation rate to be changed during the life of the contract. And like all contracts, an annuity contract is legally binding, so be sure you understand it and are completely comfortable with it before signing it and handing over any money. Next, while this shouldn't necessarily drive your decision as to whether you do or don't buy an indexed annuity, it's important to know how their fees work. In many cases, you won't explicitly have to pay any outright fees to buy the annuity. The compensation for the insurance company and the agent who sells the annuity is already indirectly accounted for in the economics of the annuity. For example, that's partly why participation rates are less than 100%. For every dollar gain in the reference stock index, the insurance company keeps some of it and passes the rest on to you. Sometimes fees are a bit more direct than that, like in the case of the 2% spread in option B. That's an outright fee, pure and simple. And to the extent you choose to buy any riders, those will have additional charges which will be deducted from your contract value each year. And keep in mind, indexed annuities pay commissions, often large commissions, especially when you start tacking on various riders. It's common for sales commissions to be about 5% of your initial purchase price, and sometimes even more. And that commission is typically paid to the agent soon after selling you the contract. That's one reason why there are such large surrender charges in annuities, because the insurance company needs you to stay in the contract long enough for them to make enough money to recoup the commission they paid the salesperson. So if you leave early, they make you pay by way of the surrender charge. And annuities have interesting tax implications. Because indexed annuities are tax-sheltered vehicles, you won't owe any taxes on them until you take money out. And depending what kind of money you use to buy the annuity, your withdrawals may be fully or only partially taxable. If you bought the annuity with tax-deferred money, like from an IRA, 100% of your withdrawals will be taxable and also subject to a 10% penalty if you're under age 59 and a half. If you instead bought it with after-tax money, a portion of your withdrawals will be considered a tax-free return of your initial contribution. The other portion will be treated as taxable interest on that contribution. Annuity taxation can be really complicated, but thankfully, the insurance company from where you buy your annuity will provide you with annual statements of what's taxable and what's not. Lastly, only buy annuities from highly rated insurance companies. Keep in mind you're buying something that has a multi-year financial guarantee. You want to do your best to make sure the insurance company behind that guarantee is actually going to be around the whole time to make good on it. There are independent companies that rate the financial strength of insurance companies. One of the most respected is AM Best. They have a rating scale that ranges from A++ to D. You only want to consider buying annuities from the insurance companies that are the strongest rated and therefore the most likely to be able to fulfill their guarantees to you. Specifically, only buy from insurers whose ratings are in the single A range. Don't buy from anyone below that. Before I wrap up, I want to share my thoughts on when an indexed annuity might be a good option. First, remember it's not an equity investment substitute. Far from it. It's much more of a fairly conservative, stable value product. With that said, I would view it as part of the fixed income portion of your portfolio. If you want something that guarantees no loss of principal, gives a moderate amount of interest, but also has the ability to maybe earn a bit more when the stock market does well, then an indexed annuity could be a good fit for you. But keep in mind there are severe early withdrawal penalties. So only consider an indexed annuity if it's part of your long-term financial plan and therefore you don't anticipate touching it for multiple years. Also, you could use them to meet some of your guaranteed lifetime income needs. If your Social Security and/or pension income isn't enough to cover your expected required expenses in retirement, then maybe an indexed annuity could be a good option. You'll have to carefully consider the various income riders and annuitization options to figure out what will be best, but it's nonetheless possible you can structure an index annuity to be a valuable source of stable and secure lifetime income. Well, that's it for my summary of index annuities. I hope you enjoyed it. And if you haven't already, don't forget to watch my other annuity videos, what is an income annuity and what is a variable annuity. Also, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.